Welcome to this explainer. Today, we're opening up a legal sandbox to look at exactly how businesses use their assets to secure essential working capital. We'll be breaking down the specific mechanics of cash credit, pledge, and hypothecation. And we're going to do this by defining the core concepts, outlining the step-by-step transaction flows, and highlighting the strict legal requirements for all the stakeholders involved. So, let's dive right in. Now, think about it for a second. If a manufacturing business needs a massive shipment of raw materials to process today, but they just don't have the immediate cash on hand to pay for it, how do they actually survive? Right? They can't just halt the factory line. So we really need to understand the financial vehicles that keep these operations running smoothly without interrupting their daily workflow. It is this fascinating balancing act between a bank's need for security and a business's need for operational cash. To demystify these financial mechanisms, here's our roadmap. 1. The need for cash credit. 2. Pledge, surrendering physical possession. 3. Hypothecation, keeping the goods. 4. Comparing the transaction flows. 5. Legal rights and liabilities. And finally, 6. The ultimate banking trade-off.
Section 1. The need for cash credit, fueling the business.
So cash credit isn't your traditional lump sum loan. It's actually a running account specifically sanctioned to customers to provide working capital. It exists entirely to meet those immediate day-to-day needs, like purchasing raw materials or processing goods. Now, what's really interesting here is the sheer efficiency of the system. Cash credit is incredibly advantageous for traders because it lets them recycle funds really quickly. You don't have idle surplus funds just sitting around gathering dust. The funds are utilized only when absolutely needed, which brilliantly minimizes the interest the business actually has to pay. However, this vehicle isn't completely perfect. While it provides a crucial lifeline by making loans available without any undue delay, the actual quantum or amount of the loan being used on any given day is decided by the borrower. The big disadvantage for the banker here is that they don't closely check the actual, daily, utilization of those specific funds. Because the bank is extending this flexible credit without micromanaging the daily spending, they absolutely must secure the loan through underlying collateral. And well, that leads us to exactly how they secure it. Section 2. Pledge. Surrendering physical possession. Governed under the Contracts Act, a pledge is formally defined as the bailment of personal property as a security for the payment of a debt. In much simpler terms, a pledge happens when the borrower, who is legally known as the pledgor, transfers possession of movable goods to the banker, the pledgee, until the loan is fully repaid. The defining characteristic here is that physical possession sits entirely with the creditor, while the actual ownership remains with the borrower. So the absolutely crucial point here is the concept of delivery. How do you actually hand over the goods? Well, delivery can be actual, like literally handing over physical gold jewels across the bank counter. But it can also be constructive. Think about it. If the collateral is a massive inventory of green, actual physical delivery is pretty much impossible. So constructive delivery means handing over the key to the warehouse or godown, or handing over the title deeds or a bill of lading. In either case, the bank has the absolute power of possession. Section 3. Hypothecation. Keeping the goods. But think about the reality of modern commerce. What if a factory just cannot simply hand over the keys to the warehouse? What if they desperately need those raw materials on the factory floor to keep producing the very goods that will eventually generate the revenue to pay back the loan? Well, this introduces our second core concept, hypothecation. Evolved as a highly pragmatic banking practice, hypothecation kicks in when a business needs a loan but absolutely must keep the raw materials. Under hypothecation, movable property is used as security, but there is absolutely no delivery of goods or transfer of physical possession to the bank. The whole dynamic fundamentally shifts here from holding physical keys to relying on a promise of trust. And this brilliantly illustrates how the law actually views this trust. Take a look at this legal precedent from the Sri Yellamma Cotton Woolen Silk Mills case. The court noted that hypothecation is essentially an extended idea of a pledge. The creditor allows the debtor to retain possession and trust of himself. As we similarly see in the Gopal Singh versus PNB case, the borrower is basically in actual possession, but they hold the goods merely as an agent of the bank. This grants the bank what we call constructive possession, even without holding the actual physical items.
Section 4. Comparing the transaction flows.
Now that we've firmly defined these security engines, let's open up the legal sandbox a bit further. On a high level, the transaction flow of a pledge requires physical transfer and highly secure storage physically managed by the bank. Hypothecation, lacking that physical control, relies entirely on administrative agreements, legal stamps, and the formal obligation to repay. Let's look at the exact steps to really see the difference here. Here is the transaction flow for a jewel loan, which is a classic pledge. Look at how physical this process is. Step 1. The bank ascertains the jewels and meticulously checks the gold quality. Step 2. They assess the market value based on strict RBI margins to decide the loan amount. Step 3. They execute a pledge document with a very precise description of the items and the number of jewels. Step 4. A promissory note is signed. And finally, Step 5. The jewels are placed in a pouch and physically sealed right in front of the customer. This highly detailed procedural flow perfectly illustrates the stringent, physical checks a banker must perform when taking actual possession of pledged goods. Now contrast that with the hypothecation flow. Because the banker doesn't have the physical goods, they must mitigate their risk through a really strict checklist of operational precautions. They require the borrower to display a nameplate right on the factory floor stating the goods are hypothecated to the bank. They mandate insurance on the stock. They heavily scrutinize the character and capacity of the borrower. They also have to conduct periodic physical inspections of the site, require regular stock statements from the borrower, and get a formal undertaking that the borrower won't pledge these exact same goods to another bank. It is essentially an ongoing administrative marathon to ensure the collateral actually exists. Section 5. Legal rights and liabilities. So, what happens when things go wrong? When physical control is separated from ownership, conflicts are pretty much inevitable. Let's examine the strict legal rights and liabilities of the stakeholders in these agreements. Let's look at a pledge first. A banker acting as a pledgee has incredibly strong rights. They have the absolute right to retain the goods until all dues are paid in full. And that doesn't just mean the principal loan amount. That includes all the interest and, importantly, any extraordinary expenses the bank incurred for the preservation of those goods. Like paying for a high-security locker just to prevent theft. But with strong rights comes strict liabilities. If a pledger defaults, the bank absolutely has the right to sell the security to recover their money. But as the 1966 case of Probit Bank Limited versus Babu Ram clearly proves, they cannot just quietly sell the assets. No way. The bank must give the borrower reasonable notice, clearly specifying their intention to sell, giving the pledger a specific timeframe to actually pay up. If the bank sells the goods without this proper notice, it attracts severe civil liability for a concept called conversion. So the right to sell is definitely not a blank check. It's a heavily regulated legal process. Conversely, while holding the goods, the bank has a strict duty to take care of them as an ordinary prudent man would take care of their own property. But the courts are pretty reasonable about this. Look at this fascinating case from 1976, M.S. Gopal Hirasingh versus PNB. In this instance, rioters completely destroyed the pledged goods. The court ruled that the banker was not liable for the loss, because during a state of complete lawlessness, the banker couldn't have realistically done anything better to safeguard the property. The legal standard is prudence, not absolute invincibility. Section 6. The ultimate banking trade-off. As we wrap up this explainer, we really need to look at the overarching risk factors that bankers face when choosing between these two systems. It ultimately comes down to a massive operational trade-off. Because hypothecation leaves the goods with the borrower, it introduces massive structural risks for the bank. The lack of physical possession means a dishonest borrower could just submit fake or inflated stock statements. They could even fraudulently hypothecate the exact same stock to 3 different rival banks. And even if the bank realizes there's a default, it's incredibly hard to just step into a factory and sell off raw materials or used vehicles. Often, unlike a pledge, selling hypothecated goods requires really painful and lengthy court intervention. Which leaves us with this final thought, this fundamental trade-off between the ironclad physical security of a pledge and the necessary operational flexibility of hypothecation is the true heartbeat of commercial lending. It's just a constant balancing act between mitigating risk and fueling commerce. It really leaves us to wonder, as we move further into an era of real-time digital tracking, blockchain supply chains, and AI inventory audits, how might technology finally bridge this gap and fundamentally change this legal landscape in the future? Thanks for joining me on this explainer. I hope this breakdown gave you a clear, structured view of how working capital is truly secured. See you next time.